Ladies and gentlemen, welcome back to the channel. Here in today's video, we're going to be talking about why I actually think now is towards the end of this pullback that we've seen in markets. Now, I'm not a financial advisor. I'm not a financial planner. I just want to offer you the bullish take on this market, which I know if you look on YouTube or you look at other sources, people are talking about the bubble is popped and they're talking about a 10% correction and blah, blah, blah. There's reason to think that markets are about to recover. And that's what I want to share with you, okay? I think the odds are starting to favor. Things are about to get better from here, okay? And this is information you critically need to know. Now, what we're going to do in this video is, again, talk about why I think markets are going to recover here. We're going to look at the news coming out today, broader market news. You know, there's one thing in particular that has to do with Scott Bessent and China that sounds really good, okay? There's a couple headlines that came out at about 10:30 p.m. last night that markets actually did not react to because markets were closed that I think you need to hear. We're also going to take a look at what Tom Lee said about this market as well. It's about a 5-minute clip that was posted to CNBC yesterday. So do me a quick favor, ladies and gentlemen, hit that like button as well as subscribe to the channel if you have not done so already, and let's get started. Oh, by the way, if you guys want to come join the trading community, check that link out down below in the description of today's episode. Even after the recent selling we've seen in markets, that under the surface, this market has really been volatile, right? A lot of AI stocks and a lot of momentum names, a lot of the high flyers have sold off quite a bit. This portfolio year to date, the trading community portfolio year to date, is still up 144.5%. At one point, we were up 220%. I still believe this portfolio by the end of the year is going to be up over 300% year to date, based on what I'm expecting and my calculations. So if you guys want to come trade with us, come invest with us, every time we make trades or find these new stocks, check that link out down below in the description of today's episode. Now, what we're really looking at are AI stocks, software AI stocks, energy companies with specific, opportunities like batteries, right? That's going to be huge for AI, for data centers, clean energy, biopharmas, gene editing companies, quantum companies, robotics companies. We are finding the under the radar opportunities, these smaller companies that Wall Street is overlooking, that don't really have a lot of analyst coverage, and taking decisive investments in those kind of stocks. Okay? If that's something you are interested in also doing, check that link out down below. But with that said, let's get into today's episode. Okay, so first things first, before we get into any of the news we're going to cover, what Tom Lee said, I want to break down why I'm bullish on this market, okay? And to do so, first and foremost, you have to understand what has really happened to this market recently, okay? The headline S&P tells a much different story versus some of the high-flying momentum areas, okay? If you look at the S&P, you're down less than 2% from all-time highs. Peak to trough decline on this market, if this corrective phase were to end, you fell about 3.2%, okay? You came down and nearly tested the 50-day moving average, basically bounced off of that, okay? Which in recent times has been a pretty important level. Even back in 2024, like once you hit that 50-day moving average, you could fall below that, but shortly thereafter you started to rebound. A lot of moments you would hit the 50-day moving average and then rebound sharply off of that, okay? If you don't bounce off the 50-day moving average, you're very likely to bounce off of this orange line, which is the 100-day moving average. So if we do get downside from here, you're really going to want to target that 100-day moving average. Now, what has been affecting this market? Three things. U.S.-China trade tensions. The government shutdown. We're basically in a data blackout, okay? It's not great. Every day it continues on. Wall Street is looking at that as negatively affecting the economy. And then you have the whole regional bank fears and uncertainties creeping back into this market. That really affected stocks on Thursday. It seemed to affect stocks less on Friday. So those are the three pillars of fear, I guess, we have in this market. Well, eventually the government's going to reopen, right? I don't really think that is a huge impactor on markets at this point. It could become a larger impactor, but government shutdowns historically do not really cause downside for stocks. In fact, they're usually correlated to upside in markets. China-U.S. trade issues are definitely the largest thing, I think, that are weighing on markets. And as we're going to talk about in just a moment, it looks like things are progressing in a positive direction. And then finally, regional banks, that's, people are going to forget about the loan problems that a couple banks are having and get back to business as usual, okay? Unless this divulges into a larger situation, which so far it doesn't look like it's going to. So I think the issues we're facing right now are really short-term in nature. Now, again, under the surface, this market has gotten pretty wrecked, okay? A lot of the momentum, the high-flying stocks recently, AI companies, are down like 30% to 50% from their prior highs we hit like 2 weeks ago. Okay, so you've definitely seen a reset in the momentum areas of this market. And when you look under the surface, like the CNN Fear and Greed Index, it's at 27. Historically, you want to be bullish and buying markets if the CNN Fear and Greed Index is in fear or extreme fear. In fact, on Thursday and for most of the day on Friday, the CNN Fear and Greed Index was at extreme fear, hitting 23 at the lowest point. Okay, you wouldn't think the CNN Fear and Greed Index is in extreme fear or pretty close to it if you looked at the headline S&P. Okay, it's really, again, under the surface that is taking the pain. Market momentum is fear, stock price strength is neutral, stock price breadth, extreme fear, put and call options fear, market volatility is fear, safe haven demand in extreme fear, and junk bond demand in extreme fear as well. AI investor sentiment survey shows bullish investors at 33.7%, neutral investors at 20.3%, and bearish investors at 46.1%. People are bearish right now. Sentiment has totally flip-flopped. And when you get this many people that are bearish, it is typically a very good sign if you are actively investing when people are this fearful. You can also see the percent of stocks trading above their 50-day moving average is now down to 42.1%. Now, during like major crashes, like back in April, at one point, only 5% of stocks were above their 50-day moving average, okay? Back in 2023, at some of the, correction levels, you were hitting 15% of stocks above their 50-day moving average. Between, 30 and 15%. Okay, that's where you start to get like really washed out. But even in the 40% range, you're starting to get quite washed out. Okay, that means that 60% of stocks or more have been in an active downtrend. Okay, like 50-day, moving averages. Okay, active downtrend. Now, again, when you look at the headline S&P, you're very resilient because it's the mega caps that really, dominate the headline S&P. But other areas are getting kind of washed out. I think largely the expectations for 2026 are intact, right? Earnings are going higher. Markets are less concerned about inflation. You can see that in the 10-year Treasury yields falling below 4%. I think people believe that AI is alive and well. We just had TSMC earnings that were great. Okay. No signs of demand for AI slowing down anytime soon. Looks like the Fed's going to be cutting multiple times over the next 12 months. It looks like maybe the real estate market picks up a little bit. The provisions in the big beautiful bill should help consumers. No tax on tips, no tax on overtime. Being able to, again, write off like car loan interest on your tax return. All of these things collectively should help the consumer recover next year. Okay? There's a lot of positive tailwinds taking place right now in the economy and in the markets. And I don't think people are just throwing that away right now. I think this market had rallied a lot, and people were looking for an excuse to sell stocks. I don't think the AI bubble, quote unquote, popped. Yes, I do think we're in the very early stages of an AI bubble that will bubble up for the next couple of years, right? Like, the bubble will pop eventually, maybe, if AI becomes so overhyped and under-delivered on, but it's not right now. It's not in the build-out phase. It's not in the, in this phase. And there will be waves to it. We haven't even gotten to the real, AI euphoria around healthcare or around robotics or some of these other industries that will eventually come. Like when, John Deere stock is exploding on prospects of autonomous, tractors and shit. When that happens, then we can start to talk about a bubble. When that's the talk of the town, then maybe we're later stages in a bubble. That hasn't happened yet. Okay? I really don't see any signs of an AI bubble popping. I see excuses from people that wanted to sell. October is sometimes a volatile month to the upside and to the downside. And I think we're just seeing that. Now, when I put all of this together, to me it looks like the downside will be short-lived. And I think people are just going to jump right back into this market. And really all it's going to take is a sentiment shift. And I do believe that bullish sentiment shift could be coming very soon. Now, with that said, take a listen to what Tom Lee just said about this market on Friday.
It's good to see you joining us from the nation's capital today. So what's your take on everything that we are talking about now daily?
Well, I heard the earlier segment, Scott, and I do think I'm kind of more in the Jamie Dimon camp, that and Steve Leisman's point that there's opacity in private credit, and that's the problem that investors are going to grapple with for some time. And I think that, along with the trade tensions and, the VIX spike, is the reason investors are a little cautious. But I don't think that's going to change that markets still have a lot of tailwinds into year end. And part of it is AI is I think demand is accelerating there. And we know that investors are sitting on a lot of cash, and institutional investors are really having a terrible year. Only 22% are beating the benchmark. So I think there's a bit of a chase. And then sentiment has flipped negative, which is always a contrarian buy signal. So, I think despite this mounting wall of worries, including the shutdown, I think it sets us up for a pretty good rally into the end of the year.
It sounds, though, like this is enough on your radar that do you think it's at least changed the game in the near term for the market?
On the private credit?
Just overall. I mean, if there are continued issues in private credit and the leveraged loan market, then the stock market's not going to take that well. I mean, you wouldn't think.
Yeah, I mean, Scott, the only thing that I don't know is how many chapters it's going to take to play out, because, there's opacity, which is what is scaring people, but then there's real credit deterioration, which I don't think that's what's happening, and I think that's why Adam and all those had called it idiosyncratic. I'm kind of in that camp because high yield spreads have behaved. So I think it's more of is the flow of capital, because I think one of the biggest sort of allocations for alternatives has been private credit. It's going to make investors pause that, maybe this market it's not as easy a return as it looks.
You told me, I think, a couple of weeks ago that 7,000 on the S&P by the end of the year was realistic. Do you still think that we could get another 5%? That's what it looks like. It's 5% between now and then. Do we have that in us?
Scott, I mean, 5% is just an average fourth quarter from 1950 to 2024. But we have the Fed easing after an extended pause. So that's 1998 and 2024. So I think that 5% might be the base case. I bet you it's going to end up being more like 7 or 8% or even possibly 10%. So I think 7,000 is the low end of what we can end the year at.
Wow. And how much do earnings have to do with that?
I mean, earnings are going to matter, but, you know, it's been a good start. I mean, we're barely into earnings season. The banks have been good. 82% of companies are beating. There's a lot more visibility of demand and then less concerns about tariffs because we're kind of working our way through it. So companies have a better sort of visibility over the next 12 months. I think the outlooks are going to be good, and I think that's going to help stocks. And, you know, I think there's a lot of room for multiples to still expand. So I don't think this market's that demanding.
I think it's interesting that you suggest that you'd be a buyer of regional banks and small caps. Why
Yes.
are you willing to do that? That's not putting your toe in the water. That's like putting the bathing suit on and jumping in. Why?
Well, I mean, Scott, you know, I know there's a lot of muscle memory for people from 2023, and that was because of a big change in rates that really caught a lot of banks offside just in their business model. That doesn't mean that this crisis, which is underwriting being done properly, should have the same issue. So I think that there has been a throw the baby with the bathwater out on the regional banks and the small caps. So yes, I think despite the fact that the Russell had a rough week, I think they're really going to be one of the beneficiaries. I mean, even on earnings basis, small cap earnings are going to grow 48% in the third quarter. That's like 4 times, 5 times bigger than the S&P. So I think there's still a lot of growth left there.
What's the message in crypto right now, Tom? Bitcoin is down today. It's 107,000 right now. What's going on there?
I think there's a couple of things. One is there was a big deleveraging last week because that VIX spike and the tariff headlines triggered the biggest liquidation and deleveraging in crypto ever in history. So I think that people are still licking their wounds. And I think that there's also a bit of gold envy because, as you know, gold has been a huge performer this year. In fact, you know, there's people waiting in line to buy gold. So I think that there is a bit of like, I'd rather own gold than crypto. So I think this is not the top of the crypto cycle, but I think levered longs in crypto are near record lows. So I think it's kind of like we're at the basement and working our way back up.
Okay. We'll see if we get there and if we're walking or taking an elevator. Tom, thanks. Enjoy the weekend, Tom Lee.
Thank you.
So yeah, Tom Lee says that 7,000 on the S&P from here is kind of a low case for the S&P into the end of this year, which from current levels is about 5.5% upside. Once you even get above 700, you're probably going to get a bit of a chase. Tom Lee says 10% could be coming. That's to about $730 on the S&P, largely driven by earnings and the fact that this recent selling has been, you know, largely misunderstood, and I think it was really just a kind of momentum thing that you know, some people wanted to take profits, right? When you look at something like the RSI, okay, take it for what it is, but the RSI has recently hit its lowest level, which was around 42 back after the 2.7% down day on October 10th. That's the lowest level you have seen since back here during the 20% crash of the first round of Trump tariffs. Okay, so even from that perspective, there is now a lot of room for markets to strengthen from here. Now, I do think you want to be a little discerning in the stocks that you're buying, right? Like, again, nuclear. I love nuclear longer term. Like, I think a lot of nuclear is going to be in demand from AI data centers. But how long is it going to take for nuclear to actually come to market? A lot of nuclear companies, I'm just throwing an example out there, are going to take 3 to 5 years before they're even generating any energy or power or revenue, right? That's not an ideal situation if they're trading at multi-billion dollar, if they're multi-billion dollar companies. You want some sense of value in the companies that you are investing in. That's the whole idea of the trading community as well, right? We don't want to just invest in the high flyers that, people love for maybe not a great reason, right? We want to invest in the companies that are trading at discounts to their peers, that are accelerating from a business perspective in these hot fields like AI, energy, robotics, quantum, right? For an example, I invest in CCCX. Out of the quantum companies, they are trading at a fraction of the others, generating more revenue than the others. And again, whether or not quantum's in a bubble, you can make that argument. But out of quantum, CCCX is by far the best stock in the quantum field that is trading at a significant discount. Okay, so that is the kind of work that we are doing. If you want to come check it out, link down below in the description of today's episode. But let's get into now your broader market news today. Now, in broader market news today, Scott Bessent, the Treasury Secretary, says, quote unquote, President Trump is asserting American sovereignty and leading our allies to push back against China's economic coercion. Netanyahu has instructed that the Rafah crossing will not be opened until further notice. The first NVIDIA Blackwell wafer has been produced in the United States per NVIDIA, which is a huge milestone. IKEA says it will be raising its prices due to Trump's furniture tariffs. And in breaking news, government officials have confirmed that Americans are still required to file and pay federal taxes on time, despite the government shutdown. Not surprising. They they're going to want their money regardless if the government is open or not. Also in the news today, Trump officials are quietly discussing a Kim Jong-un meeting during the upcoming Asia trip. China's vice premier says U.S. Treasury Secretary sincere, thorough, and China's vice premier at 10:31 p.m. last night, so after markets were closed, futures or overnight trading was closed, U.S. Treasury Secretary in sincere, thorough, and positive talks. So things seem to be going in the right direction on China trade. And Chinese Vice Premier Li Lefeng speaks with U.S. Treasury Secretary Bessent by video call. U.S. Treasury Secretary Bessent says planning to meet in person next week for further discussion. Bessent says that Vice Premier Li Lefeng and I engaged in open and detailed discussions about trade between the United States and China. So again, seemingly heading in the right direction. And apparently the U.S. has drafted countermeasures if negotiations fail with China, which is, again, that's not really new information. But sounds like a scary headline. Trump to implement a 25% tariff on heavy-duty trucks effective November 1st, according to a senior U.S. official. Trump says meeting with President Volodymyr Zelensky of Ukraine was very interesting and cordial. A new poll is finding that more people are starting to blame Democrats for the government shutdown. So that is all of the news that you need to know over this weekend so far. But just to take a look at where broader markets closed the Friday trading day, the CNN Fear and Greed Index closed at 27, which is deep into fear territory. Market momentum is fear, stock price strength is neutral, stock price breadth, extreme fear, put and call options, fear, market volatility is fear, safe haven demand, extreme fear, and junk bond demand in extreme fear as well. We do have the AI investor sentiment survey that came out on Thursday. If you have not seen this, I think it's critical that you understand what this means. Bullish investors at 33.7%, neutral investors at 20.3%, and bearish investors skyrocketing to 46.1%, up from 35.6% last week. So bears are fully in control of this market. The sentiment has dramatically shifted. Whether you're looking at the CNN Fear and Greed Index, whether you're looking at positioning in markets, whether you're looking at the AI investor sentiment survey, it really doesn't matter what you're looking at. It all shows the same thing. People are bearish right now. And when people are bearish is when you want to be investing, historically speaking. So with that said, ladies and gentlemen, let me know your thoughts on all of this down below in the comment section. Have a fantastic rest of your day, Oh, by the way, if you guys have $1,000 laying around and want to start up a new brokerage, Public is this brokerage that I use for the trading community. I absolutely love it. You can break down income from dividends, right? In Q2 2025, this portfolio received $170 in dividends. In Q3, it received $66 in dividends. In Q4 2025, it's projected to receive $78 in dividends. You can look at the Income Hub, right? And projections for the next 12 months are projecting, not a lot of dividends because I got rid of the dividend stocks and went into some other names. But you get the idea, right? You can look at 2023 and 2024 dividend histories, and that's just one aspect. You can look at stocks and their market caps. You can look at allocations, equities, right? Obviously, account values, and, all kinds of different interesting tools. You can click on a stock like Resolve, one that I'm heavily invested in, have over 31,000 shares invested in. You can look at all the analyst price targets, okay? The average price target on Resolve, $9 a share. Roth Capital, the latest price target, $12.50 per share, okay? Bear case, bull case arguments. Look at the company by market cap. This is one of my favorite features, right? You can look at the highest the market cap was, $2.12 billion. You can look at where the market cap was, back on August 25th, $748 million. Today, it's at $1.57 billion. So you can look at companies that maybe look like they were $4,000 a share a long time ago and actually look at the market cap and say, okay, the stock wasn't actually at $4,000 a share. There was just a lot of dilution, for an example, right? So there's a lot of very cool tools. If you sign up with the link down below in the description of this video for a limited time and deposit $1,000 when you fund your account, you will get $100 in stock of your choosing, whether that's Resolve or any other stock that you like right now. And a lot of them are on discounts. So take advantage of that link down below. Have a great rest of your day, ladies and gentlemen, and I will see you in the next one.